Thanks very much, Radhika, and a very warm welcome to all the assembled audience here and those who are tuning in live and watching us across Business Today's various platforms. Mr. Khara, very warm welcome to you, and I want to begin by letting the audience know and extending congratulations for Mr. Khara's appointment as the chairperson of a very important committee that's been set up to review India's insurance laws. You would recall that the budget has announced 100% FDI in insurance, and consequently some legislative work needs to happen. Before I go into the macro banking questions, maybe just a word or two from you on what is this entire exercise aimed at, and what will come of the insurance reforms committee that you are heading.
Thank you very much, first of all, for having me on this event. Well, when it comes to this new committee which has been constituted to review the insurance law was due for updation or amendment. So essentially the committee's role is to review the key parameters with a very clear intent: how can we offer insurance for all by the year 2047. So which actually means that the scale up of the insurance sector has to happen, which also means that there is a need to understand the felt insurance needs of the people who have remained uncovered, because when it comes to the insurance penetration, it continues to be low, and how can we improve the penetration, which means that the distribution structure needs to be revisited, the licensing, the capital requirement, and etc. All these things needs to be relooked into. So with that in mind, this committee has been constituted, and it has got the representation from the insurance sector, from the regulatory point of view. There is a representation from the regulators also, and also I've been assigned this responsibility. So I think I expect that we should be in a position to do a reasonably decent job.
By when is the report likely?
We have been given a mandate of 12 weeks.
All right, so that's pretty good. I know there will be more news flow in 3 months. Let me come back to the banking point. And Mr. Khara has been a lifetime banker. He has helmed the State Bank of India, not just India's largest bank, but amongst those banks that are respected globally for the size and scale. And during his tenure, not just traditional banking, but also SBI's forays into the technology-led world of banking. But Mr. Khara, I want you to begin by telling us about your thoughts on the whole process of reforms that has been ongoing for our banking sector, and that needs to continue to contribute to bringing India's economy to a $5 trillion target. You've been a practitioner. Now as a former state banker, what would you say needs to be done to meet that target from a banking perspective?
Well, banking, to my mind, is always a proxy to the real economy. And because it's a proxy to the real economy, much of it depends upon how the real economy performs. But yes, of course, we have seen the journey of India and how it has moved up and how it has become one of the top 5 economies. So naturally, to address the economic needs, the banks have to keep on evolving it and also keep on offering the solutions. So while doing so, they have been consuming when it comes to the digital public infrastructure which has got created in the country. I think it has really made the life easier for the banks in terms of carrying out some of the operational activities, and also that is one of the reasons why the banks could actually scale up much better and at a much faster pace also. So I think I would say that from the point of view of this is what it comes to when it comes to adoption of technology, but at the same time the regulatory environment has also kept on changing with the passage of time to ensure that the environment in which the banks are operating, banks should stay insulated from the potential risk. There is adequate appreciation of the risk culture in the bank. There is adequate appreciation of the compliance culture. It's actually, I would say that it is not that it's only a journey. It keeps on improving with the passage of time. And the only requirement is the bank should keep pace with the times. Bank should keep on looking at what's happening new and how can it be absorbed within the operations. So eventually, I would say that these are the reasons why today banking stands on a much different pedestal as compared to what it was way back in 2016-17. So I think the banks have very well adopted how they need to stay focused on the risk and how they need to manage it. Of course, at times it is said that it's a cyclical industry, but I would say that if at all the fundamentals or the principles are very well understood, then perhaps there is always a effort on the banks to stay ahead of the curve and remain relevant, and also it remains on very sound footing as well.
Mr. Khara, barring the State Bank of India, there is no other Indian bank which is amongst the top 50 globally. Scale, depth and corporate governance will be critical for banks to continue to raise capital to be lenders for India's massive development, whether it is infrastructure or consumption needs. Two parts to the question. Do you see a future where there will be other banks in the top 50, top 25, including for SBI? And second, the journey towards achieving scale and higher corporate governance, how long will it continue to be?
I think when it comes to one among the top 50, there is one important aspect which perhaps cannot be ignored. When it comes to the Indian bank's balance sheet, they are all denominated in rupee. And when it comes to the global ranking of the banks, it is all in terms of the US dollar. So actually one of the important component is the rupee dollar parity also. So if at all you start evaluating the size of the banks or their reckoning in the league table on the purchasing power parity basis, perhaps there would be many more who would, as it is, feature into that. But nevertheless, having said that, now your question is that how can, whether it will be a situation where others will also come in. Well, of course, I think when it comes to the growth of the bank's balance sheet, you have rightly mentioned that unless and until there is a capital, they will not be in a position to grow. So here is a situation where there is an effort on the part of banks to improve their operating leverage and also the financial leverage. So I think once we start, we are in a position to blend both in terms of improving the operating leverage and the financial leverage. And also I would like to add one more, which is actually the technology leverage. So I think once this is achieved, I'm sure we would actually get to see many more banks coming into this top league table also.
The budget for FY24 had spoken about amendments to certain critical banking laws. For example, the Reserve Bank of India Act or the Act of Banking Companies Acquisition and Transfer of Undertakings Act. Banking is obviously the bridge for Viksit Bharat. In your experience and standing as a banker, public sector banker of 4 decades and more, what is the legal or regulatory framework changes that are required to allow Indian banks to do a much better job?
Well, I think as I mentioned that banks are proxy to the real economy, and because we have seen that the economy is evolving at a very fast pace, there are many new players who have come into play. And also, how can we integrate, how can we create a very stable ecosystem around That is one of the needs, and today banking is no more what the banks does. Actually, banking is one of the important component of the ecosystem, and how well the ecosystem performs will actually define the efficiency of the bank also. So I think these are some of the realities which have undergone a change. At the same time, when it comes to the one of the major amendment which has been brought in is in terms of one of the major amendment which has been talked about is in terms of the nomination, the number of nomination, the way it is there for you know for newer instruments like when it comes to the mutual fund, etc. The similar kind of nomination rules were not permissible in case of banks. So all that is getting addressed. So I think essentially I would say that this is a very welcome step to ensure that the wherever there is a need for any amendment, I mean through this statement in the budget, it has been acknowledged that there is a felt need and it will be looked into.
Will further consolidation, there's been one big round of consolidation in the public sector banking space in the last decade or so. Is further consolidation required, and will it help ensuring that banking services become even better?
See, for an economy of our size, there is a scope for banks of all sizes. If at all it's a smaller one, then probably they can carve out a niche in which they can become very efficient. So essentially, there is a need for efficient players. I think size is material and important, but at the same time there is a room for some of the niche players as well. So I think to my mind, when it comes to the consolidation, consolidation has to be seen from the point of view that if at all it actually brings in what is complementary, and also it gives newer muscles to the post-merger entity, then perhaps it is worthwhile, because invariably at any acquisition or any consolidation there is always some kind of a pain. So the pain is worth taking if at all there is a gain eventually. So without gain, is it worthwhile to take the pain, is a matter of debate.
What will the bank of the future look like in India? Will it be a digital beast? I ask you this question because over the last several years we have seen new companies in the fintech space bring amazing speed to the customer. Digital KYC, Aadhaar, the Jam Trinity, all of that have helped. For public and private sector banks, they had legacy systems, so they took time to change. But it is now clear that all banks also have massive investments in technology. Given this, what will the bank of the future look like, let's say, maybe 5 years down the line, Mr. Khara?
Well, when it comes to the bank of the future, when we draw some kind of parallel from the developed economies, we still see the relevance of the branch banking or the physical banking. When we look around India as an economy, we have a rural sector. How well it will evolve, we need to wait and watch. And also we will have a demographic scenario where we will have the young, old and middle-aged population. But adoption of the technology by all this customer segment, and also the penetration of the digital network across, will probably define how the banks will look like. But to my mind, I think the way I have seen in last about 40 years or so, we have moved from absolutely purely physical to the phygital stage. And today also, when we look at the volume of transactions which are being handled through the digital mechanism by the banks have gone up multiple times. It would be as high as about 90% plus. But there is still the relevance of the physical locations. But yes, what will be the shape of those physical branches? That might undergo a change. It will become merely the sales and service hub, because I would say that 25 years from now, perhaps we will have a situation where uh, hyper personalization or customization will be the way forward. And for that to really happen, one, of course, we will be in a position to draw upon the analytics and the behavioral aspect from the data, but nevertheless, it will perhaps involve a very personal engagement also. So, in fact, the usual complaint which you have seen from the developed nations and the banks which are operating in those developed nations, the customers keep on complaining that we don't get to hear the voice of a human. We always get to hear the voice of a Siri. So I think this is something, this is a reality which we cannot ignore. I'm sure there would be enough room and space for the physical operations also. So phygital, I would say, would be the future banking. But yes, of course, when it comes to banks, banks will probably go beyond the pure play banking. They will get into advisory, they will get into more and more customer centric approaches, and they will probably offer the whole gamut of financial services, may not be confining themselves to the banking products only. And this is something which I believe is likely to be the scenario. But when it comes to whether they will offer product beyond the financial sector, as of now, the regulation does not allow that to happen. But yes, of course, I think the way regulations and the acts and the everything is changing, maybe with the passage of time, when there is a felt need, when I mean, so many other players would like to sweat the kind of distribution network which has been created over all these years, maybe one can actually experience something which would be aligned or ancillary to the financial sector, may also be serviced through the banks in those 25 years plus.
Since we are talking about regulation, does India need more banks? Is there a need for more banking licenses to be given out, given the size of the economy and the size of the population that has to be served?
I think I would draw a parallel to the year 1990, when the new private sector banks came into existence. So if you really ask, at any point of time, there would be limited scope for the newer entities. But newer entities, if at all they are coming in, they actually have to offer the value add services which are not being offered currently. And that is something which actually makes the incumbent players also to think out of box, and that is something which always brings in more and more competition, and which is eventually in the interest of the customer. So I think if we look at the size of the economy and the number of banks, perhaps when it comes to raising capital, investors always look at the ROA and the ROE, and from that point of view, the ability of the banks to support the growing economy depends upon the ability of the banks to raise the capital and the deposits, and to service the customers according to where the need is. It is also a reality that when it comes to investment into risk, when it comes to investment into compliance, when it comes to investment into technology, these are the areas where banks will have to keep on increasingly invest. So I think much of it will depend upon the muscle of those newer entities in terms of their ability to raise capital. That is going to define whether I would say that there is always a room for the newer players, and they can always come in, but they will have to bring in something new which will actually bring in a change into the whole ecosystem.
Since you spoke about the ability to raise capital, I don't know how many in our audience know that there's been a sharp fall in private equity funding in the fintech space in the last couple of years. Traditional banks have closed the gap in terms of technology, and regulatory arbitrage, which had a factor, is perhaps now not a thing of the past. Is there a possibility of a scenario like we have seen in several other sectors, that old incumbents take time to respond, but eventually once they get their act together, they create a situation where newer entrants find it very tough to survive. And added to that, should there be some amount of fair play regulation in ensuring that newer entrants also survive along with behemoths like State Bank of India and other banks?
No, I think the way I look at this is that it's not an either or situation. Actually speaking, it's a situation of collaboration. And the larger entities can always consume the solutions offered by the maybe the technology service providers. And today, when it comes to their ask, it is actually increasing every day. And with the increasing focus for leveraging analytics, for increasing focus for becoming more and more customer centric, I think there is a ample scope for these newer entities also to really support the banks. And when you talked about whether banks will be in a position to newer entities will be in a position to support their capital requirement, I would say that even in some stages, even banks also have got some capital, and you would have seen that some of the private sector banks have actually invested into some of the technology companies. So I think this is going to be the newer reality, newer norm. And why only the newer, private sector players? Even the incumbent public sector players also have got their technology arms, which they have actually set up many, many years back. So I would say that it's going to be a collaborative approach. All these players in the ecosystem are very, very important. And actually speaking, today with the kind of risk which is there in the banking system, I would say that the risk of the banking system will be defined in terms of the risk-taking ability of the lowest common denominator in the whole ecosystem.
As we speak, one of the big challenges for our banking system in India has been the battle for deposits. We've seen the recent slackness in deposit growth, and many people say that it's a structural change that is happening in the market. People, instead of going in for fixed deposit, are investing in various stock market instruments. The credit deposit ratio has obviously felt the impact. But the question I have for you is it time to relook the cash reserve ratio? Because many people say, Mr. Khara, that it is nothing but dead weight as far as the banks are concerned.
See, I tell you, when it comes to the deposit, there is a statistics which is available which talks about when it comes to the composition of the bank deposits. As far as the retail deposit component is concerned, it has come down from about 63% to about 61% over a period of from 2018 to 2024. The major shift has actually come in the government deposit, which used to be somewhere around 14% of the banking system deposit. It has come down to about 9%. And at the same time, the corporate deposits have gone up to about 18% from about 10%. So this is how the scenario has changed. So I think when it comes to deposit, I think what has happened is that because government deposit used to be kept in the current account, or maybe that was one of the reasons why the CASA was looking better. So now, thanks to the just-in-time adoption of the government, that kind of float is not available. So that is one of the reasons why this kind of a scenario is actually, it has evolved. The other very important factor is that, when it comes to the M0 growth has come down significantly. It is somewhere around the range of 5%. So M0 multiplied by the multiplier effect actually gives that M3. That is how it works. So now in this particular situation, what has happened is that since M0 has grown only 5% because there was a very clear focus in terms of containing the inflation as far as the central bank was concerned. So these are some of the factors which have led to the kind of scenario which we have seen for the deposit. Now, I think when it comes to the customer's behavior in terms of choice of asset class, it will keep on changing depending upon how the markets are operating. Where do they see the certainty of the yield certainty of the returns, they will actually go for that. I think that aspect we probably cannot really control much. So as far as deposit is concerned, this is something which is actually is actually giving the clear perspective in terms of what has happened to deposit. Having said that, I would say that deposit and the credit is almost growing at about 11%, 10% kind of a number. Perhaps once the inflation, the way this trajectory is, it is coming down, and inflation gets addressed, maybe the ability of the RBI to pump in more M0 will also be there, and which will actually give rise to the deposit which will be available. So having said that, I think banks have to look at it in a manner that deposit is something which is more like a franchise for them. Okay. So they have to offer it, and even for the customers also, it will continue to be a static component of their one component of their total asset allocation. Portfolio. Whether it remains in favor of or otherwise, deposit will remain part of their holdings. So I think to that extent, of course, banks have to remain relevant. Banks have to try and see that how best they can offer the services to the customers, and they can address their customers' need. So that is something which, this is how they will have to really operate.
You know, there was as I conclude this conversation, one quick final point. There was a lot of demand that there should be tax relief on interest earned on fixed deposits. That did not happen, but a massive tax break has been given up to 12 lakh. In your reading, because this is the Business Today Banking and Economy Summit, I have to ask you that final question. What is the likely economic impact, and do you really expect a significant consumption booster?
Well, this tax break will actually generate about 1 trillion odd money, and depending upon the demography, generally we have seen in the past the MPS is somewhere around 0.50, if at all. That is the kind of a situation. So about 50,000 crore worth of money should be saved, and the remaining 50,000 crore can be spent. So to that extent, it will actually help in terms of improving the deposit growth, and also to some extent addressing the challenges of the unsecured credit which we have seen in the past. So I think that is something where it will get deployed. The other 50,000 crore which will be essentially going for the consumption, that will certainly give a boost to the growth in terms of the GDP also. But nevertheless, I would also like to highlight that, of course, it has not been talked about much. In this budget, there is a talk about giving 50 years interest-free soft loan to the state governments, and we have seen in the analysis that it was actually state governments and the central government did not spend money for infrastructure creation. That is something which has led to the lower growth in the second quarter, which was about 5.6%. So I think, to my mind, infrastructure, the way we have seen infrastructure, the multiplier effect of the infrastructure spending is as high as from 2.8 to as high as to 4 times. So I think with the kind of focus on infrastructure spending at a central level, and also a push for spending at a state government level, there is going to be a huge push for the growth in the GDP. So I think that is one of the reasons why the early indications, of course, we are waiting for the GDP numbers as on 28th February, but we are quite hopeful that we should be crossing, we should be somewhere around 6.5 as far as the GDP growth number is concerned. So I think with the kind of spending for infrastructure which will be seen through the central level and also from the state government level, we will actually get to see significantly higher impact in terms of the GDP growth in the days to come. And of course, this money which has been spared through the in the taxation, that will also supplement the growth of the GDP.
Mr. Khara, thank you very much for sharing your thoughts with us and headlining the first session of the Business Today Banking and Economy Summit. Thank you very much for your time with us today. A round
Thank
of
you very
applause
much.
for Mr. Khara.